I guess why don't you introduce yourself, talk about how you got there,
Sure.
how you found yourself in Qualia today.
So I guess first off, who's heard of Unison? Okay, that's pretty good. Still for your people at home, there's very few of them. We've been around for a little while, but we're trying to kind of reinvent how you buy and own a home. So if you want to buy a home, you typically have to use a mortgage or borrow money. But with us, you can we give you money now. You don't pay us a cent until you sell your house, and then we'll actually share in the increase or decrease of the value of the home. And you can live in it for 20 years. And you don't have to talk to us, or you don't have to hear from us for 20 years, and then we'll net it out then.
That's crazy. So you'll just give people money.
Just like that. It's the easiest business model ever. Really, yeah.
So talk about like why is this a useful product?
So and maybe I'll go back to the question that you asked, and it will tie into the answer to this. I did my Master of Financial Engineering at Berkeley, and I did my thesis on kind of portfolio optimization with very large and illiquid assets, like a home. And I think it was finding that people were actually investing an incredible amount of money, like more than their net worth in this home. And so if you imagine you walked into your financial advisor's office and they told you, all right, we're gonna take all of your money and we're gonna lend you 10 times that amount, and we're gonna put it all on in the stock market or in Amazon. I mean, you would immediately lose respect for this person's credentials. Like you would probably, and you'd never refer anyone to this person. Yet, this is the game that real estate agents and loan officers play. Like, just to be very frank about it. And so, what Unison does is we wanted to give you the ability to kind of take some chips off the table. You should be able to buy your home and not have like 10 times your net worth, in exposure to this asset. Keep a little bit of that money, save it for a rainy day in case you have medical expenses come up, or you want to kind of diversify to other assets like the stock market or bonds. So I think we can, when you buy a house, down payment's one of the vectors that you need to get across. Monthly payments is another one, but risk is this other kind of important vector, and I think we're trying to solve that problem.
So are you a down payment assistance, or is it kind of you will also come in after someone owns a home?
Yeah, those are the two products. Our home buyer product, which is this down payment assistance, which kind of helps you with that to come up with a down payment to buy the home. That's actually a lot. And when I joined the company, I thought that was going to be our biggest product line. It's actually a really small portion of the business right now. The vast majority of our business has been people who already own a home. And maybe I can talk a little bit about why I think that that's the case. But yeah, something like 90% of our business right now is people who are in their 40s. They have a lot of assets. They don't really need to pull money out of their homes. They've paid down their mortgage, but they just want to free up some of this frozen equity that's in this asset, and maybe buy a boat or something, or put it into the stock market.
Do you think it's? I guess first off, do you own a house in San Francisco?
I do not own a house in San Francisco.
Yeah, would you be I guess you would be a potential user of this product. Like,
absolutely.
Why haven't you used it yet?
I just have a wonderful roommates that I want to continue to live with for a while. No, but it's a good question. And there's a bigger question of why aren't young people buying homes? That's a big trend that's emerged in the last 20 years or so. It's like how do we get kind of this next generation of people buying homes? People are living in homes longer, and I don't know if we know the answer. It's definitely. I mean, one thing is just the affordability problem. Kind of a lot of students still have student debt. They're not willing to kind of take on that huge mortgage.
Is it the proper financial decision to buy a house in San Francisco? Like, if you can, with this down payment assistance?
If you were going to buy a home in San Francisco, you should definitely either use a rich uncle or Unison to help you buy a home. But it's unless you have, I don't know, let's assume that you have $200,000 saved up. If you want to buy a home in San Francisco, that's $1 million. And so when we first started talking, was one of the first things that we talked about was like, how much do you lose in the transaction alone, right? I think we came up with like 10% after all the fees that you're paying to different people. So, all right, you have $200,000. You go out, you buy $1 million home. You've lost $100,000. That's like already gone. So you've lost half your net worth. Now you're taking a levered bet though. So and when you're buying a house, you're like the most optimistic. I don't know if you've ever gone gambling or if any of you trade in a brokerage account. Like you're the most excited about an investment right when you're about to make it, and then once it's on the table, you realize, oh wow, if this home goes down by 10% now, I'm completely broke. And so I think having, like you said, the rich uncle or Unison to kind of share in the upside and downside, it's just a lot safer, maybe a little less stressful. You can enjoy your house a little bit more. And maybe that ties back to why people want to continue renting. Like, do we really want to have that much uncertainty in life?
Yeah. So historically, residential real estate is something that's been, very much owned by the person who lives in it.
Right.
I think after 2008 with Invitation Homes and some of these, very large companies that would own tons and tons of single-family rentals, that became more common.
Mm-hmm.
Do you think that we're going to move more and more to a world where you have institutionally owned or partially institutionally owned single-family assets, or like is it just a historical coincidence that it exists how it does right now?
Okay, those are two very interesting questions. So the first one, I think these models of people of not just having kind of you're either a renter or a buyer, having these like rent to owns are really interesting businesses that have been coming out, and then obviously businesses like Unison, Point, Patch Homes to kind of bridge that gap. Why is it the way that it is now, and why hasn't this happened yet, is a question I keep asking myself. I think if you look at the history of finance, debt markets always emerge before equity markets. So we think of ourselves as like we're making an equity investment in your home, like we're buying stock in your house, whereas a mortgage is lending you money on your home. The debt and usury it goes back to the Bible, but like the first stocks, like in really I think like the Dutch East Indian Trading Company, it takes a lot more regulation, like legal contracts to actually make equity investments. So I think there's just this, the way we need technology, we needed more information, we needed better, better systems to kind of create equity markets to make it.
One thing that
more developed.
feels like a problem is also that you have to. You have someone who's your partner, mm-hmm. who's now living in this house, who like may or may not be taking care of this asset that you partially own.
Right.
How do you deal with that? And like, are you allowed to like leave holes in your roof if Unison owns part of your house?
Yeah, no, that's a really good question. So, well, one of the appeals, and I'll start with put my sales hat on and start with the positive side of that question, which is that this is what we tell our investors. It's like, hey, if you want, and this goes back to your previous question, is like investors don't have access to single-family homes that people live in. The reason they don't is because to do that, you'd have to buy up a ton of single-family homes, maintain them yourselves, rent them out, take rental risk, take vacancy risk. It's very expensive, and you have to have people on the ground solving these problems. One of the things we sell to our investors is an asset that's going to take care of itself. Like we're only taking kind of a small percentage of the change in value. So this is a machine that's running itself, and so to answer the specific question is if someone is leaving holes in their roof or something, then we need to get that repaired, and that will come out of the pocket of the homeowner. Like there is an agreement to maintain the house in livable condition.
That's very interesting. Is that something you ever have problems with, or?
There have been very rare cases where it's been an issue, but it's never been a very serious issue. It's something that can be solved with, it's a small amount of the final payoff kind of thing.
That's very interesting. So maybe give kind of a overview of like how is the actual deal structured? Like how does it come together?
Yeah, and I'll do it with an example. So let's say you have $1 million home, and you want to take $100,000 out. So we'll give you $100,000 today. And then that's in exchange for we'll share in 40% of the change in value after that point. So you have $1 million home, I give you today $100,000, and let's say in 5 years it goes up 10%, just to keep the numbers simple. So you're gonna give me back my $100,000 plus 40% of that change in value. So the home went from $1 million to $1.1 million. We'll get 40% of that change in value, $100,000. So that's $40,000 on top of it.
Got it.
On the flip side, if it went down to $900,000, we would actually lose $40,000, and so you'd only give us back the 60. So that's how we kind of share in the change in value, take some of the risk off.
How do you approach like modeling this on your side? And like, I know this is part of what you do.
Yeah.
Like maybe talk about, you know, how do you price this?
Okay, yeah, it's a very, very good question. This is basically what I do for a living. So we have, I don't know if you guys, what kind of data sets do you guys use do you use any property level data here? So there's some amazing data sets of, you can actually like see, like for every single home in America, 130 million, you can see like everything about each home, like the number of rooms it has, square footage, if it has a pool or not. So we can use that data. We also have every transaction for every single home. So we can actually go back in time to the 80s and originate a fake Unison contract on each of these homes and follow them to the actual sale. Do that, it's called the historical simulation, and just kind of go through and see, based on how we price it, can we get above a return where your average pension plan, for example, would invest their next dollar in our company. And that's the framework that we go about it.
So are you picking like particular cities, or like how do you approach like where to distribute this product?
Yeah, so there's a lot of selection that goes into it. We look for factors. So I was just talking about how you have a vector of everything about a particular home. Like, does it have a pool, for example? You can test that factor. Does having a pool give you a higher returning portfolio than not having a pool?
Does it?
That does not. The pools are actually not very good investments. They're a lot of fun though, so you might enjoy it, but I wouldn't use that as I wouldn't use like the investment quality of that as a reason to get a pool installed. But so you would say like if you're trying to buy a house, you should avoid houses that have pools. Not necessarily, but if someone was like, I want to install a pool,
yeah.
We would advise them not to. For that, it would not add a lot of value. It wouldn't add the same amount of value as it would cost them.
Interesting. It's good to know.
So one thing we do is called factor modeling. I gave you one example, but you can do it on a lot of other things. So one thing, we try not to look at the world as cities. Try to look at every home individually and like what is around that home, how many jobs are around that home, what's like the density, can you keep building out? And so we try to answer these questions, come up with a thoughtful model that I can actually explain to my investors, and then we can simulate homes that have the highest wage jobs around them. Do they perform better than homes that are out in farm country? Yeah. And these are the types of things that we look at.
So we had someone from Open Door give a talk on pricing. And
who was it?
I can't remember who it was, but it was very interesting because there's an adverse selection issue. Yeah. Where they are more likely to get people who have some major negative defect in their house who are interested in this type of thing. Yeah. Like there's a hole in the roof, right. Or their backyard like opens into a cliff or something like that. Mm-hmm. Like, how do you deal with that? Yeah. Like, how do you actually go physically inspect the homes?
We do home inspections and appraisals to look for this exact issue. And there are people who try to slip a fast one on us. We like to think we're pretty good at catching these things. We do a lot. We take a lot of like images of the property, but that is a real issue. I mean, I'll give you the exact scenario. We call this slippage. It goes by a bunch of different names, but I give you an offer on your house, right? I'm like, I think your house is worth $800,000. If you know that your house is actually worth more than that, you're just not going to do a deal with me. But if you know your house is worth $700,000, you'll be like the first to come and take money from us. And so having that, it's kind of like it's like a game of poker where we have to kind of show our hand first, and so we do have to model that and take that into account.
Yeah, that seems like there's potentially a lot of risk there.
Mm-hmm. Definitely. The best way to solve those problems though is not. I don't think it's to do it by playing the poker game with them. It's more about trying to target people who you know aren't going to exploit that. So we target people who are going to stay in their home for more than 3 years, which washes out that effect a little bit. Yeah, we want people who are not just like flipping a home. That's kind of our biggest fear, is to get someone who's just using us to flip properties.
So one issue with this is that you have potentially a very long duration on this investment. Like, you know, Travis uses your product and then he buys a house and lives in the house for the next 50 years. Like you're not getting your money back anytime soon. Like, how does that work?
So one way we solve that is we actually have a 30-year cap on the product. So after 30 years, we demand a payment. And it's actually not unreasonable, because any mortgage that you have, you're going to have paid down sufficiently where you could, if you were still in your house after 30 years and you have no debt on the house, you could cash out, refi, and buy us out at that point. 50 years that's a long time too. Statistically, a very small number of people will be in their homes after 30 years, so we can kind of model out that risk a little bit as well.
Yep. Well, let's just say 20. Like,
sure, 20. Yeah.
You got a really long duration. Like, that seems like a problem.
Yeah.
Like, how do you capitalize these equity investments?
It's a great point. And I think that's a lot harder on some of our competitors, like Point and Patch, who invest their own balance sheet money. So they have a VC on their back who's trying to get their money out in 5 years, and they're making like long-term investments. That's not what we do.
So how accurate do you actually need to get the pricing? I wonder if is it more about the legal structure and how everything is set up, or is it like in winning the deal, or like I would imagine the margins are good. Like, how accurate does it actually need to be?
The margins are good. I think the pricing has always been a little bit less of a concern. Just structuring a good asset that aligns both the consumer and the investor, and understanding that the consumer and the investor, or the homeowner and the investor, they want completely different things. And when two people want different things, you usually can make a deal happen. Like the homeowner wants cash now. They're not worried about 20 years down the line. An investor doesn't. They have too much. These investors have too much cash now, and they only care about the return down the line. So just like you can structure a deal that's compelling for the investor. It's going to work for the homeowner. I don't believe in having a different price for every single home in the country. So really, and I think that might be where you're going, is should we have a very specific pricing rate for every single home? We could do that, but then I think I would be skeptical as a consumer. I'd be like, you're gaming me. I always feel like I'm losing that.
Got it. Okay, what questions we have? Mo.
How do you secure the investment? So multiple ways that somebody can have the property. The homeowner can pass away. There may be a divorce. They may sell and not tell you. How do you secure the investment until they get paid?
Yeah, that's a great question. We do it very similar to how a second mortgage would be secured. So get a lien on the property, get ourselves on title. And that kind of solves, that's somewhat of a solved problem in America. In other countries, it's a completely unsolved problem. So we'd have trouble, expanding to, some developing countries for that reason. But here, we stick really close to the mortgage game, and they've kind of solved a lot of those problems. You can't.
Are you paying for the fees and all the costs?
Yeah.
So they just get a check net of all that, or?
That's right.
Do they get more money the longer they stay in the property, or do you get more money the longer they stay in the property, or is it you're going to make the same thing regardless, but they're for 2 years or for 3 years?
So do you mean us as Unison or the investor?
As Unison.
Okay, so as Unison, yeah, we do. So we charge a management fee on the asset. So every year, and we make that from the investor. The investor makes more money the longer the home is, right? Because they're getting, on average, a home's going to go up in value, typically.
But the trend lately has been that homeowners are staying for less time, right?
You mean for less time? So.
So they're not sticking around for 20, 30 years.
Right.
More mobile society, people are getting jobs in different places.
Right. Yeah. See, I thought that too, and I was looking at the data. I think what happened was there's a smaller group of people who stay in their houses for way longer, and then you have the remaining people who are intelligently not buying a house. They're just renting, right, and moving around a lot more. So that has been there's kind of two trends that coincide. As home ownership rates are decreasing, so you have more and more homes are being held by both institutions and mom and pop investment property owners, landlords. So that means more people are renting, and you have people are far more mobile, kind of moving from city to city. So, and I think one of the things we talked about in that research of like, if it costs you 10% to buy a house, you kind of need to live in it for like 5 years to really kind of wash away that risk. And so I think people know that if I'm not staying in this house for more than 5 years, I shouldn't be buying it. And so yeah, these are things that we have to be aware of. That one, if you're a homeowner, you're probably actually going to stay in longer, and that a lot fewer young people are actually buying homes.
Two questions. One is property taxes. Does that come into play at all?
Okay, yeah, so the questions about property taxes, so just like a mortgage would expect the homeowner to pay, have insurance on the home, keep their property taxes up to date, so that they get to live in the home, so we expect them to maintain it and to maintain those liabilities associated with the property.
Then you talked about general house prices going up, but you also said sometimes you can take a loss when it goes down. Do you have any influence or say if they're looking to sell and you're like, that's a bad time to sell, you can hold on for another year? Like, are you guys on that point?
Yeah, it's so the question is, can we influence people's selling decision if we think that they're not selling at the right time? So the answer is no. We really don't want to influence the behavior and the experience of the homeowner. If they want to sell and they get a real arm's length sale, they can't just sell to their cousin for $1. Like, right, that wouldn't be cool. We would probably step in at that point, but if they sell just because they want, for any other legitimate reason, we have to take that sale price.
Sure.
You talked about qualifying the property, and I'm curious, do you do anything different than a loan officer would to qualify the consumer?
So yeah, the question is, so we talked about deciding on property. Do we actually have any kind of stricter guidelines around the homeowner? We stay very close to what the lenders and loan officers do, just there's a lot of regulatory tape around that problem. We can't be caught discriminating, so there's very specific vectors that we can look at, like FICO score, what's the loan to value in the mortgage, what's the debt to income ratio that we're allowed to qualify. So we actually don't do too much different than what a loan officer would do. But we do try to target kind of higher quality kind of prime borrowers. That's the space that we operate in.
And so I know you got some questions.
I got a huge list. I'm waiting for one. Because I'll bore everyone else.
Questions?
So there's a lot of different market forces right now. Like interest rates are low, student debt is really high, there's a trade war. What are the main forces that you pay attention to when you're looking at how the market overall right now?
So what are the main market forces that drive home prices? So one of them is like median wage is an important one. More important that we found recently than median wage is 75th percentile wage. So housing is typically not only driven by economic expansion, but it's actually driven by inequality as well. So if inequality of income and wealth increase, home prices will actually increase. They're driven really by the wealthier groups of people. The other really important part, another really important driver for home prices was kind of down payment requirements. So we talked about affordability. I'll go back to this because this is interesting. So the two main drivers of affordability are your monthly payment, right, and the down payment. And so for the last 50 years, wages haven't really gone up that much. So what do? Let's just drop interest rates, and that way, home prices will continue to be affordable because I'm not making more money, but the interest rate on my mortgage is lower, so I can afford a bigger and better house. Okay, we solved that problem. But now, wealth actually also hasn't increased. So the amount of money you have in your bank account hasn't been going up. Okay, so how about instead of having to put down 20% on the house, you only have to put down 10% or 5%. And these are some places where we've gotten into trouble in the past. Let's say like in 2008, this was the biggest concern. So those two dimensions are like very, very important for predicting how much home prices will continue to go up. So the construction numbers are really important. So the amount of new supply in the market is also a big driver. Those are kind of the big ones that we look at.
So I guess how are you accounting for your models for the things that you couldn't possibly predict? And what I'm going with this is like natural disasters. Like you thought Houston was going to appreciate, bad hurricanes, bad seasonality happens, and now the value has increased substantially.
We put random variables in for those. Any of the data scientists in the house know you add the Z term at the end to kind of like deal with. There's some things we just can't know, right? Like understanding those natural disasters. Those is a really interesting one because those are they're not like normally distributed. It's really like a jump. Like you can lose a lot. So these are, one thing. This is more of this is maybe not answering your question directly, but you might find this interesting. So one thing, I was talking to Peyton about this, was like, should we invest in areas that we know in 20 years will get flooded? And it became less of a debate about the returns of our portfolio. It became more of a debate of like, is it ethical to continue to like contribute to helping people stay in areas where we know it's going to be dangerous for them to be? Wildfires are a huge issue. That's been a more recent one.
Are people required to carry earthquake insurance in San Francisco?
I don't think that not for our product, and I don't think they are for mortgages either. I have to look at that one again.
Okay. And it's only you got two questions.
I got two?
Yeah, not okay.
Oh.
All right, so we're gonna allocate them.
The first one, I buy a house in 2008
Yes.
for $1 million in San Francisco.
Yeah. We have
Get $100,000 from you. It's 2018. This house is worth $4 million.
Mm-hmm.
Now you get 40% equity in the $3 million increase. I go to court, sue you for predatory lending.
Mm-hmm.
Do you have any protections against that?
Well, so the protection. I actually have an answer for you, but no, it's a legitimate. It's something we worry about. Like we want to make sure that. It's a fair question. So we actually have, when you do a deal with us, you have to go. There's like a huge educational program that we do. It's got like fun diagrams and like little calculators and things like that. That you have to go through. You really have to understand what what you're actually giving up and what you're getting in return. Although well, the other things, we're not actually a lender, so we would.
So you do secure by due trust or mortgage, right?
Yes, but that's not necessarily that's not the qualification for lending, right?
You're securing performance, basically.
Exactly. So it has more of an equity structure, and so it does fall more into the equity securities camp. So we're not like collecting interest that isn't tied to, that's basically like no matter how bad the house does, you have to pay interest. That's a separate point. Otherwise, no, we're creating a new asset class, so we have to be very careful to manage the positive experience of our homeowners and make sure that we don't have some sort of a crisis like that could tarnish the product. I mean, take reverse mortgages, for example. Really a good product that got tarnished because you had some bad eggs going out and originating them with people who really shouldn't have been, originating them. So,
second question. Imagine, do you have any type of first right of first refusal or anything similar to ensure that even like a short sale scenario that you wiped out correctly, but you would actually buy out at that cost?
Yeah, that's how we solve from the selling to your cousin for $1 problem. Is we can buy the home for $1 more than the commanding offer if we think that we've never had to do that, but that's just there as a reminder that you can't just try to defraud us out of a non-arm's length deal. So and then that is also applicable for foreclosures and short sales. We've actually used that in an interesting case where it's somewhat separate, but we had this retired couple who their home, they were about to go into foreclosure, but they actually had a ton of equity in their home. Like the mortgage balance was way lower than the value of the home, and we knew it. And so they were about to get foreclosed on. The bank would have fire sold the house. They would have ended up with nothing, and they probably would have had to go back to work. And I think they'd been out of the workforce for like 10 years. So we went in and started paying their mortgage for them. It took 3 months. We like set the house up, had an orderly sale, and they walked away with something like $400,000. The bank ended up with their entire principal back, and our investors made a really good return. So it was kind of like that was real like efficiency in the marketplace by intervention.
Like a notice of default or something similar to track that, or are you just monitoring foreclosure notices?
So can you guys?
Do you record a notice of default request for notice, or do you simply every day check to see if anyone's in foreclosure and the notice is recorded?
Oh yeah, we monitor, we monitor for every property, just like a lender can. You can monitor if the tax is current. You can monitor if I can't remember if you can monitor on if insurance is upheld, but you can monitor mortgage payments to make sure that they're not delinquent. And so that's how we noticed it. They were like 60 to 90 days delinquent, and the home was worth. It was a great home. Mortgage was pretty low, so it didn't make any sense. So that was a good opportunity for intervention, and it was we used that framework when we were talking to the bank. We're like, we can let us come in, have the right of first refusal on the home, and pay the mortgage. That gave them confidence to let us handle that. It's kind of
Okay, we got 2 last questions here.
All right.
Alright, so you said you had like historical data that you use to make like data-driven decisions about like where you're going to like give loans, I guess,
Mhm.
loans to people. But like, how do you know like which dates to choose? Like for example, if you have like information from like the 1980s and you use that data, I'm sure it would be like San Francisco is like the best spot to like invest, right?
Yeah.
Whereas like, how can you decide like, okay, we're gonna start using the data from like this date?
Yeah, it's a good question. So you have to. This is a solution. This is a problem in kind of every data science. Any like inquiry is: are you just picking too short of a time frame, right? So one solution is to look over a long enough time frame, right? Another is to actually figure out what factors are driving excess returns, rather than just saying like, oh, because we don't. That's why I was saying we avoid looking at like San Francisco as not a factor, in my opinion. Like wages, like co-integration of returns with wages, that's a factor because it's something that is, cross-sectionally. You can get a lot of data across the country, and you're not. You avoid kind of cherry picking particular places that did really well for a while and then could lull forever. Like take Japan forever. Japan was the best place to buy real estate up until it wasn't, and for 30 years homes haven't gone up in value. And so yeah, you have to kind of. The question is not like where are homes going up in value. It's like what causes a home to go up in value, and you're digging kind of that next level down is important.
I'm curious how you all decide how much of the equity you're willing to like take of the house. Like, do you ever buy more than half? And like, why don't you just buy the whole house? In some cases, like.
Yeah, I mean, then they would just be renting, right? I mean,
Right.
like it's kind of like there's a continuum. I want to buy. I want to make sure the homeowner has enough skin in the game so that they're going to maintain the home, right? Like that's the spirit of it. Is that we're co-owners. I'm a silent second. I'm not going to bother you. You get to have the home like as if it was yours. But I'm here to protect your loss if it goes down in value, and I'm here to share in the gain if it goes up in value. And that's and share, not take the whole game. And I think that's the important thing. And that and it makes sense. Like people kind of want to, they don't want to give up all the upside.
Cool. Okay. Any closing thoughts? Anything you want to add?
I hope that we can do business with you guys pretty soon on our home buyer product. Maybe that will help.
Sounds exciting.
I just wanted to talk a little bit about like why I think real estate is an amazing game to be in. And I think it's it's unlike any other asset class. It's like one of the biggest asset classes in the world, and it's in the hands of like your everyday people. It's not just in the hands of institutions. So I think anything that you guys do to make to reduce the friction at sale, to make it a better experience to buy a home, to own a home, like you're gonna make a real difference in people's lives. I think that's something to be proud of. It's something that's like very inspiring to work on, at least personally. And it's like the oldest asset class too, but in some ways it's still the most like the least developed or the least efficient, the least like technologically driven. So I think it's really cool what you guys are doing, and I think hopefully there's a chance for us to work together.
Cool. Thank you for coming in.
Thanks for having me, guys.